I'd say the start of the pandemic was truly devastating. We typically own brand-managed hotels that are 400 rooms and larger, and typically in the Smile states of Florida, Texas, Arizona, California, Hawaii, Cabo.
Nice.
And we had to close all of these properties. And I've likened it to stopping a supertanker midstream trying to close these hotels. But we used that time to really complete renovation work, to accelerate repositioning of the assets. We also used that time to raise our first commingled fund, which was a GP fund, and became one of the largest, most active buyers of hotels in the US during that time. I will say that all of these properties that were closed during the pandemic have come roaring back. They're now renovated. They're seeing incredible demand, having record month-over-month performance. So we've come out of it well, but it was scary at the start of the pandemic.
Do you foresee that kind of demand continuing? We've just been trying to figure out what that leisure travel budget winds up looking like for those that have budgets and for those that don't.
I just read a statistic today, Alex, that said that in June, luxury demand was up for hotels 9%. And I think there's a 2% decrease in demand for the economy segment. What we're seeing with the work from home phenomenon in the US is that every weekend is now a 3 or 4 day weekend. So people are traveling more. At the same time, with the companies having to shrink their office space, they can't hold offsites in their offices anymore. So they're holding more offsite meetings to bring their teams together in the types of hotels that we own. So we're seeing compression between the leisure traveler and these offsite group corporate type travelers. So it's baited well for our properties.
So if you wanted to go out and buy a property, or if you wanted to refinance a property today, will the bankers pick up your phone calls? I mean, are the banks lending here?
We've been fortunate. I'd say our business more and more relies on relationships. And fortunately for us, we have tremendous relationships in the lending market and in the private equity. A lot of our partners are large private equity funds. We've completed well over $2 billion of financings and refinancings over the last 11, 12 months. So we see it robust. There has been more of a shift towards CMBS or SASB loans, but we've had loans as large as $150 million all the way up to $750 million that we've been able to execute in the last 12 months.
And are you getting that from banks, or is it private credit? Like, where do you go for that?
So it's a mixture of SASB and then non-bank banks.
What is SASB? I'm sure I should know this, but
it's the CMBS market, so single asset, single borrower,
okay.
CMBS market. And so, that market is very active right now. We just refinanced our Diplomat Resort in Hollywood, Florida. It was a $575 million transaction about 2 months ago. We bought a resort for that Accor, which is a non-bank bank. They financed us in Scottsdale, Arizona. But it's all down to relationships.
You recently expanded into Europe. Tell us about that.
We're very excited about Europe. So Ryan Don, one of our partners, moved to London about a year ago, really at the request of some of our joint venture partners who wanted an operating partner like Trinity in Europe. We completed our first acquisition about 2 months ago. We bought the Park Hyatt Hotel in Zurich in partnership with Oaktree and UBS. And Ryan now has the core team of head of development acquisitions, asset management, etc. So we're very excited about the prospects in Europe.
who are your competitors? Is that a really silly question?
We compete with all of the private equity funds, but they tend to be our joint venture partners as well. So we've done a lot of business with Oaktree, we've done a lot of business with Partners Group, with UBS, with Elliott Management, and so we partner with these groups. They rely on us for our in-house expertise. We have 45 professionals who live, breathe, and sleep hospitality. That's what they do. We're hospitality real estate experts. And fortunately, our competitors also collaborate with us.
What's a typical property that screens well for you guys in terms of an acquisition? What do you guys really look for, whether it's size or location or capital structure? How do you screen that?
In the US, we typically focus on brand managed, so mainly Hilton, Marriott, or Hyatt. And we typically focus on properties that are 400 rooms and larger, that are more destination type properties. And these tend to be in Florida, Texas, Arizona, California, and Hawaii.
So you would own the property, but Hilton would manage it?
Correct.
Okay.
And we're so fortunate with the relationships we have with the brands who really trust us with the assets. And we also buy from the brands. So we've bought 3 assets from Hyatt as they've gone on an asset light strategy. So Zurich was one, Greenwich, Connecticut was another one, and then Indian Wells in California was a third one. But
So
Again, I'm not hearing Cleveland here. I'm not hearing Des Moines.
Do you want to go to Des Moines?
I mean,
Stop. Of course we do.
We do. I mean, like, sure, but I mean, from what you're saying,
Don't
these
be
are
dissing
sort of.
these places.
I'm not dissing
You
the
just
places.
did.
I'm dissing the location for hotels. In that, if I'm going to go to a destination and I'm going to send a work trip or something, I'm not going to go to Des Moines. I'm going to go to a place where I can soak up sun and be in a pool and that kind of stuff.
Well, what we've learned is that you need multiple levers because things do happen like COVID that are unforeseen. So when you have one of these destination type properties, you have multiple levers between group, corporate, leisure, meeting space, etc., that you can play with to induce demand to the assets.
So, are you guys net buyers today? Are you net sellers? Where are you?
Holding.
All of the above. We're definitely net buyers. You know, I think we're going to see the debt market stabilize. While we've been successful in them, you do need a more robust debt market to induce buyers. I think the minute we see, hopefully, an interest rate cut, you'll see a lot of demand coming back into the market. So we do have assets that are approaching stabilization, and in the right conditions, we will sell.
Well, you know, Alex and I often, when we talk about commercial real estate, we just think about here, the 3rd Avenue in Manhattan, and we're hearing from experts that when these things trade on the 3rd Avenue in Manhattan, they're B office kind of properties, 30, 40 cents on the dollar.
Yeah.
If you go out and make an acquisition today of a hotel, you're not getting a discount, are you? I mean, are these things trading at about where they were trading, or are they trading at a discount to pre-pandemic?
I would normally walk into a convention or a conference as the hotel guy, and you know, you'd be sort of the afterthought in terms of an asset class for real estate. What we've proven coming out of COVID is that we've been able to stay ahead of inflation because you essentially reprice on a nightly basis. So you can reprice your rooms, your food and beverage. The other side is that we typically trade at wider cap rates. So if we're buying at a 7 cap and we're financing at an 8% all-in interest rate, there's slight negative leverage, and it's a value-add investment that we normally do, so we work our way into positive territory pretty quickly. If you're predicated on buying the other real estate asset classes at a 4% cap rate, which used to need a 3% interest rate to make it work, you're way underwater in terms of that spread between where the cap rates and the interest rates are now.